Ever wondered how massive companies, the ones operating globally, actually manage their money, especially when dealing with different currencies? I mean, how do they make sure that a big sale in, say, Europe actually translates into the dollars they expect back home with exchange rates bouncing around all the time?
Okay, let's unpack this. Today, we're doing a deep dive into exactly that. Foreign exchange risk management. We'll use a specific case study, a company called Learnsignal Co.
That's right. So Learnsignal Co. is a U.S.-based firm. They make medical equipment. They've just landed a sale with a Swiss customer. The deal is for 12.25 million Swiss francs. That's CHF. But here's the catch. Payment isn't due until May 31st, 20x9. And today, in our scenario, it's November 30th, 20x8.
Yeah.
So our mission really is to figure out which hedging strategy out of 4 common ones gets them the most U.S. dollars in the end. And what's great is that our sources for this dive really lay it all out like a playbook. It gives us a systematic way to look at this, pulling out the key insights for you, the listener.
Right, so here's where it gets really interesting. Why does Learnsignal Co. even need to bother with hedging? They're a U.S. company getting paid in Swiss francs. That sounds good, but it opens them up to risk, doesn't it? Foreign exchange risk.
Exactly. The risk is that between now, November, and next May, the U.S. dollar could get stronger compared to the Swiss francs. If that happens, their CHF 12.25 million, when converted back, will be worth fewer U.S. dollars. That hits their profit directly.
Ouch. Okay, so hedging is basically like insurance against that.
Precisely. It's about reducing that uncertainty, mitigating the exchange rate risk. They want to lock in a predictable amount of U.S. dollars.
Makes sense. And their treasury team is looking at 4 options.
Yep. 4 main methods. Forward contracts, something called money market hedging, then traded currency futures, and finally, traded currency options. Each has its pros and cons. Let's start with the first one, forward contracts. Sounds pretty straightforward.
It generally is. A forward contract is basically a simple agreement you make with your bank. You agree today to exchange a set amount of currency, in this case CHF for USD, on a specific future date, May 31st, at an exchange rate you agree on now.
Okay, so they'd sell the CHF 12.25 million forward.
Correct. They'd use the 6-month forward rate because the payment is 6 months away. The bank quotes them, let's say, USCCHF 1.0356, 1.0378.
Ah, the 2 prices. How do they know which one applies?
Good question. You often hear the phrase, the bank always wins, or maybe more accurately, they use the bid-ask spread. Since Learnsignal is selling CHF to get USD, the bank will give them the lower rate.
The lower rate benefits the bank when they're buying from Learnsignal.
Exactly, so they'll get the 1.0356 rate.
So the calculation is just CHF 12,250,000 times 1.0356.
That's it, which comes out to $12,686,100. Guaranteed, locked in.
That sounds incredibly appealing. Certainty. You know exactly what you're getting.
It is. That certainty is the big advantage. The flip side, of course, is that if the Swiss franc happened to strengthen unexpectedly against the dollar,
they wouldn't benefit. They're stuck with the agreed rate.
Correct. You give up potential upside for that guaranteed downside protection.
Okay. Method 2, money market hedging. This sounds a bit more intricate.
It is a bit more involved, yeah. It uses borrowing and lending in the 2 different currency markets to kind of synthetically create a forward rate.
How does that work for a receipt like Learnsignal's CHF?
It's basically a 3-step process. First, Learnsignal borrows Swiss francs today. Not the full amount, but just enough so that the loan plus the interest due in 6 months will exactly equal the CHF 12.25 million they're expecting from the customer.
Ah, so the customer payment repays the loan?
Precisely. The Swiss borrowing rate is 4.4% annually, so that's 2.2% for 6 months. Doing the math, they'd need to borrow about CHF 11,986,301 today.
Okay, step 1, borrow CHF. Then what?
Step 2, immediately convert those borrowed Swiss francs, the CHF, 11,986,301 into US dollars. Right now, using today's spot rate, spot quote is, say, US CHF 1.0292, 1.0309. Again, they're selling CHF, so they use the lower rate, 1.0292.
So CHF 11,986,386,301 US dollars right now.
And step 3, they can't just keep that, right?
Right. Step 3, they invest those US dollars in the US for the 6 months until May 31st. The US deposit rate is 4.6% annually, so 2.3% for 6 months.
Okay, so they invest the 12,336,301 at 2.3%.
So you take that amount and multiply it by 1 plus 0.023.
And the final amount they receive in US dollars is?
It comes out to $12,620,036. That's their effective receipt locked in via the money market hedge.
Wow, that's definitely more steps than the forward contract. Why go through all that trouble?
Sometimes, depending on the interest rate differences between the two countries and the bank's forward margins, this method can actually result in a better effective exchange rate. It bypasses the bank's explicit forward. But it adds complexity, more transactions, more chances for small errors, maybe.
That's the trade-off.
Yeah.
More operational steps, definitely.
Okay, on to method 3, currency futures. How are these different from forwards?
Futures are similar in concept, locking in a future exchange rate, but they're standardized contracts traded on an organized exchange, not custom agreements with a bank.
Standardized, meaning fixed amounts and dates.
Exactly. Fixed contract sizes, fixed maturity dates. For New Turn, selling CHF, they'd sell CHF futures contracts. They need a contract that expires after their May 31st payment date. Looking at the options, that would be the June contract, priced at 1.0369 US CHF.
And the contract size. They need to cover CHF 12.25 million.
The standard CHF contract is, say, CHF 125,000. So you divide 12.25 million by 125,000.
Which gives 98 contracts.
That's right, 98 contracts. Now, futures have this concept called basis.
Basis. What's that?
It's the difference between the spot exchange rate today and the futures price for that future date. So today's spot is 1.0292. The June future is 1.0369. The basis is mainly 0.00077. Theoretically, this basis should shrink to zero by the time the futures contract matures at the end of June. The New Turn's transaction is May 31st, slightly before maturity.
So some basis might still exist.
Exactly. We need to estimate the unexpired basis on May 31st. Since May 31st is about 6 months out of the 7-month period from November 30th to the end of June, roughly 1/7 of the basis might remain.
Okay, so 1/7 of man is 0.00077.
Yeah, which is about May to 0.0011. This tiny bit of unexpired basis adjusts the effective rate they lock in. So the lock-in rate isn't just the futures price of 1.0369, it's 1.0369 plus that estimated unexpired basis of negative 0.0358.
I see. So the expected receipt is the CHF 12,250,000 multiplied by this adjusted rate, 1.0358.
Correct. That gives us $12,688,550.
Slightly higher than the forward contract. But you mentioned basis risk. That adjustment isn't guaranteed, right?
That's the key risk with futures. We assume the basis shrinks linearly. In reality, it might not, especially if markets get volatile. So the final outcome might be slightly different from that $12,688,550. Less certainty than a forward.
Okay, makes sense. Last method, currency options. These sound different.
They are. Options give you the right, but not the obligation, to exchange currency at a specific rate called a strike price, on or before a certain date.
Right, but not obligation, so flexibility.
Exactly. Since New Turn wants protection, if the CHF weakens, meaning they get fewer USD, but wants to benefit if it strengthens, they would buy put options on CHF. A put option gives the right to sell CHF at the strike price.
Okay, so they buy June CHF puts. Same logic as futures for the date.
Yep. Let's say they look at a strike price of 1.0375 US CHF. Again, they need 98 contracts to cover the bulk of their CHF 12.25 million exposure. 98 contracts, CHF Dumbra, and 25,000 contract.
And if they exercise these options at 1.0375?
If they exercise for that portion, they'd get CHF 12,250,000 times 1.0375. Oh, wait, sorry, it's for contract. 98 contracts times CHF 125,000 per contract times the strike price, 1.0375. That gives $12,709,375. The source also mentions a tiny remaining bit, CHF 50,000, that gets hedged separately using a forward contract at 1.0356, adding about $51,780.
Okay, so that sounds like a high potential receipt, but there's a catch, right? Options aren't free.
Exactly. That flexibility comes at a cost. The option premium, you have to pay upfront for the right. Let's say the premium for these June 1.0375 puts is 0.86 US cents per CHF. So for the whole amount hedged by options?
For the 98 contracts, the total premium is 98 contracts, 125,000 CHF contracts, 0.006 CHF. That's a cost of $105,350 paid now, regardless of whether they exercise later.
Oof, that's a significant cost. So the net receipt is the potential gain minus this premium. Correct. If we take the receipt from exercising, $12,709,375, plus the small forward portion, $51,780, and then subtract that premium, $105,350. The final net receipt, according to the source's calculation, which might simplify some details, comes out to $12,604,025.
Okay, we've crunched the numbers for all four. Let's put them side by side. This is the moment of truth for New Turnco.
All right, let's recap the final US dollar receipt for each method. Forward contract, $12,686,100. Money market hedge, $12,620,036. Futures contract, $12,688,550.
So based purely on maximizing the US dollar receipt in this specific scenario.
The futures contract method wins, yielding the highest amount at $12,688,550.
That's really interesting. Futures came out on top just slightly ahead of forwards, and options, despite that high strike price we looked at, ended up last because of the premium cost.
That's the crucial takeaway about options. The premium is the price of flexibility. You pay for the option to benefit from favorable rate movements while still being protected. In this case, that cost outweighed the benefit of the strike price compared to the other methods.
And while futures won here, there's still that caveat about basis risk.
Absolutely. That $12,688,550 from futures is an expected value based on an assumption about how basis behaves. The actual outcome could be slightly different. Forwards give you absolute certainty. Futures give you near certainty, usually very close, but with that small element of basis risk.
So it really highlights the trade-offs companies face.
It does. It's not just about the highest number on paper today. It's about risk appetite, the desire for certainty versus potential upside, operational complexity.
Wow. So we've taken this complex problem, broken it down using these four methods, and seen how each offers a different balance of risk and reward for New Turnco. It really shows the strategic thinking involved.
Exactly. And if we zoom out, this isn't just an academic exercise. Evaluating these tools, understanding basis risk, premium costs, interest rate differentials, it's fundamental to managing finances in our global economy. It's about creating stability in a dynamic world.
So thinking about all this, what really stands out to you? Consider that balance. The absolute certainty of a forward, the slight uncertainty but potentially higher return of futures, the flexibility at a cost of options. How do you think a real treasurer weighs those? When might they choose guaranteed predictability over a potentially better but less certain outcome? Something to think about. We hope you keep exploring these kinds of questions.